This episode of the Buildcoin podcast is proudly sponsored by Moral.money. The most moral form of money? No money at all. At Moral.money, you can exchange your valuable skills like coaching, consulting, or training for essential resources without using traditional money. Imagine getting everything you need like solar energy systems, water filters, or even a car simply by offering your expertise. No business registration, no payment gateways, and no tax hassles. Just your skills for the essentials you need. Visit Moral.money today and discover a new way to live ethically and sustainably.
Preface: the story of Roger Ver, once known as Bitcoin Jesus, now finds himself facing severe charges from the U.S. government, charges that could potentially land him in prison for life. The act of renunciation triggered what is known as an exit tax, designed explicitly to penalize high-net-worth individuals who decide to abandon their American citizenship. Had Roger Ver never renounced his citizenship, no taxable event would have occurred in 2014. However, the heart of the current legal conflict originates from 2017, 3 years after his citizenship renouncement, when his US-based companies sold significant holdings in Bitcoin. This is because significant price gains had happened during this period, and this accounts for the bulk of the claims. The U.S. government's case is predicated on the claim that these sales represent a substantial taxable event, alleging that Roger Ver failed to declare and pay taxes appropriately. Crucially, their argument hinges on the belief that these Bitcoin sales constitute speculative gains rather than appreciation driven by fiat currency inflation. This legal dispute happens to coincide with the release of Roger Ver's new book in 2024, wherein he boldly argues that Bitcoin's original ethos has been corrupted by a cartel who is now controlled by private entities, and those same entities have corrupted government regulatory agencies. This hijacking has transformed what was intended to be a pseudonymous, privacy-focused currency into a surveillance token, undermining its initial anti-government foundations. The history of Roger Ver is deeply woven into the controversial block wars, fierce debates over Bitcoin's direction that led to its fracturing known as forking into BTC, BCH, Bitcoin Cash, and BSV, Bitcoin SV. Roger became a prominent advocate for Bitcoin Cash, BCH, emphasizing scalability, utility as cash, and anti-government principles, positioning himself explicitly against BTC's increasingly regulated and centralized evolution. Yet, Roger Ver's antagonistic relationship with U.S. governmental authority began much earlier. In his youth, when he ran for a political position, and he boldly publicly criticized the federal government, particularly the ATF's handling of the tragic siege in Waco, Texas, which resulted in the deaths of innocent children. This outspoken criticism made him a target. The U.S. government responded by charging and sentencing him to a year in prison for the minor offense of selling unlicensed firecrackers, an unprecedented punishment for a commonplace action. This selective and punitive measure starkly contrasts the routine sale and supply of explosives and munitions in international conflicts, some which have been classified as genocide such as those occurring in Gaza, without any legal repercussions. Nearly 10 years after Ver severed ties with his homeland, seemingly seeks not merely tax revenues but symbolic retribution against a figure who has continuously challenged its financial and regulatory authority. At stake in this legal confrontation is more than Roger Ver's freedom. It is a fundamental question about the limits of governmental jurisdiction, the nature of taxation, and the philosophical foundations of financial autonomy in the digital age. Notably, he sold his Bitcoin nearly a decade ago, not in secret, but publicly and deliberately, as a political act. It was a protest against what he believed was the hijacking of Bitcoin by corrupt private interests operating in collusion with government agencies. In a space where anonymity is easy and silence is safe, he chose transparency. He didn't quietly cash out and disappear. Instead, he stood by his principles and explained his decision openly, knowing full well that doing so could invite backlash. Ironically, it is this very honesty, this refusal to lie or hide, that now appears to have made him a target. Had he kept quiet, it's likely this case would never have emerged. The agencies now pursuing him might never have known about the sale, and even if they had, it would likely have resulted in a standard audit or administrative action. But the nature of this prosecution suggests that it's driven more by what he has wrote than what he did. His recently published book tells the deeper story, documenting how Bitcoin, once a tool for censorship-resistant money in cheap, peer-to-peer transactions, has been systematically stripped of its original purpose. According to his research, powerful private entities with close ties to regulatory and intelligence agencies have captured the protocol and turned it into a tightly controlled asset, serving institutional agendas and state interests, rather than individual freedom. In his words, they've reduced Bitcoin from a symbol of resistance to a compliant instrument of control. This context casts the prosecution in a troubling light. It suggests this isn't just about tax, it's about silencing a dissident voice. Someone who dared to call out the erosion of Bitcoin's ideals. Someone who used his gains to support peace, transparency, and accountability. Someone who could have stayed silent and avoided all of this, but chose instead to speak up. And now, the price of that honesty appears to be a politically motivated legal campaign designed to discredit and punish him. Introduction. The crossroads. Roger Ver now finds himself trapped on the Mediterranean island of Majorca, awaiting extradition to the United States on charges he vehemently denies. No longer simply Bitcoin Jesus, he is a man stripped of his liberty, facing an uncertain and dangerous fate. From the moment news of his arrest spread, Roger has urgently tried to raise public awareness, repeatedly stating, "I am not suicidal." These words carry chilling weight in light of the tragic fate of John McAfee, another outspoken advocate for financial freedom who was found dead under suspicious circumstances in the same Spanish prison that held Roger. Official reports called it suicide, but many, including Roger, believe otherwise. Roger's defense team understands the risks of extradition, navigating the same treacherous legal path that led to McAfee's demise. Visionaries challenging financial power structures, both confronted with imprisonment or death. The shadow of McAfee's fate looms heavy, serving as a grim warning. With his ability to communicate sharply diminished, effectively censored, Roger fights to share his story, not as a wealthy figure embroiled in tax disputes, but as a voice challenging an empire. His case is about more than unpaid taxes, it's about power, control, and the suppression of dissent. Historically, those who threaten entrenched interests face swift retribution. 2,000 years ago, Rome executed Jesus of Nazareth for challenging its authority. Today, Roger Ver finds himself in a similar position, persecuted not for wrongdoing, but for representing a threat to the financial order. His story is part of the timeless struggle between individual freedom and institutional power. Published weeks before his current legal battle, Roger's new book exposes how Bitcoin, once a tool of financial liberation, has been hijacked by cartel-like interests and transformed into a surveillance apparatus. This message has infuriated powerful forces, providing motive for his prosecution. Despite repeated efforts by his legal team to draw global attention, media narratives reduce his case to that of a wealthy man evading taxes, conveniently obscuring deeper truths. Roger renounced his U.S. citizenship in 2014, and physically left the USA in 2006, nearly 20 years ago, yet he is pursued as if he never left. What is this case really about, and why it matters to us at Buildcoin? At first glance, this case appears to be about one man, Roger Ver, and his battle with U.S. tax authorities. But for us at Buildcoin, it represents something much bigger, a global inflection point in the debate over the future of money, regulation, and ethical economic systems. Yes, Roger Ver is the individual at the center of this legal fight. But this is not just a personal attack, it is a symbolic one. It targets a generation of people who believed, perhaps naively, that Bitcoin and crypto could offer a complete escape from the state, from taxation, from corruption, and from control. We at Buildcoin share many of those ideals: peace, privacy, individual empowerment, but we are not blind to the systemic flaws in Bitcoin, crypto, and so-called unregulated blockchain economies. In truth, a currency without regulation is not free. It's simply vulnerable. Vulnerable to the biggest thug in town, whether that's a government, a whale, a hacker, or an anonymous cartel hiding behind code. In a system without rules, the tyrant with the most power fills the vacuum. We've seen it before, wealth hidden in secret vaults, guarded by warlords, from the days of Alexander the Great to the digital shadow banks of today. Secrecy is not security. And Bitcoin, with its myth of decentralization, has proven just how easily corrupted, surveilled, and captured such a system can be. Roger Ver sold his Bitcoin publicly, not for profit, but as a political statement. His mistake was not the sale, but his belief that honesty and transparency would protect him. Technically allows, there would likely be no case. But he didn't. He told the truth, and that truth was inconvenient to powerful interests. His book reveals how Bitcoin was hijacked by private actors aligned with state institutions, transforming a tool of freedom into an asset of control. That story is not only credible, it's playing out in real time. We believe Roger's legal defense must go beyond procedural technicalities. We must address the deeper inconsistency. If the U.S. government claims the right to retroactively classify Bitcoin as taxable property, then it opens the door to a dangerous precedent. Retroactive enforcement has always been viewed with caution under democratic rule of law. If retroactive tax policy is fair game, then logically, it must be applied consistently, not only to peaceful individuals like Roger, but to corporations and financial actors who amassed wealth through war profiteering, colonial exploitation, or financial manipulation, many of whom still operate today under the same corporate umbrellas and bank accounts. At Buildcoin, we support Roger's right to a fair trial and a robust defense. But we also see this as an opportunity to expose a much bigger conversation. Bitcoin is not secure. Crypto is not immune. Inflation is not incidental. And taxation, especially when applied arbitrarily and retroactively, is not justice. Buildcoin was born out of the need to fix these contradictions. We believe in a world where economic value is tied to real assets, secured by fair governance, and guided by ethical principles, not secret keys or invisible whales. This case shows exactly why such a system is needed. Our legal team has prepared a strong defense for Roger Ver based on constitutional principles and economic facts, with artificial intelligence analysts estimating an 80% probability of success, if the process remains fair. Yet Roger knows justice is not guaranteed. His greatest defense lies in public awareness. This case is not just about him, it's about the precedent it sets for financial autonomy. If Roger is silenced, the message will be clear: challenge the system, and you too will face persecution. Now, as readers turn the page, they will encounter our meticulously crafted legal defense, a rigorous argument demonstrating the flaws in the charges against him. This is his best hope for survival, justice, and the preservation of liberty. Hijacking Bitcoin, the hidden forces behind BTC. In 2024, Roger Ver released Hijacking Bitcoin, exposing how powerful Wall Street entities, most notably implicating how BlackRock and Cantor Fitzgerald, co-opted Bitcoin, transforming it from a decentralized asset into a surveillance-friendly financial instrument under institutional control. Roger Ver asserts that these entities, leveraging government connections, secured Bitcoin ETF approvals, centralizing vast BTC holdings and subjecting the currency to strict regulatory oversight. The once censorship-resistant tool of financial sovereignty is now a monitored asset, regulated through KYC policies and institutional control. He and his co-author Stephen Patterson details how the U.S. Department of Justice, DOJ, played a role in this transformation, selectively enforcing regulations while facilitating Wall Street's control of Bitcoin. BlackRock's strategic ETF approval, which coincided with regulatory crackdowns on decentralized competitors, reinforcing what many call regulatory capture. The book sparked immediate controversy, coinciding with Roger's indictment, an event he and his supporters see as retaliation for exposing Bitcoin's corruption, much like McAfee before him. The Tether angle conspiracy. Roger Ver and Stephen Patterson also highlight in interviews the role of Tether, USDT, in manipulating Bitcoin's market. Tether, linked to the market-making capacity of Cantor Fitzgerald, who get to play dirty in the so-called unregulated markets of crypto where the rules of insider trading and market manipulation don't yet apply. A major U.S. Federal Reserve dealer, And Tether allegedly prints vast amounts of unbacked stablecoins to loan to Cantor Fitzgerald, who then have the power to artificially inflate or deflate Bitcoin's price and potentially profit of the liquidations that causes. This liquidity, many argue, enables market manipulation by Wall Street insiders, systematically extracting wealth from retail investors through engineered volatility. Tether's opaque financial operations, close ties to institutional market makers, and outsized influence on Bitcoin's price volatility reveal a deeply manipulated system. These are the uncomfortable truths that threaten entrenched interests, truths the DOJ appears to sidestep, choosing instead to selectively prosecute dissenters while allowing Wall Street's de facto Bitcoin cartel to operate with impunity. Roger Ver versus Goliath. Within this backdrop of financial conspiracy and political persecution, Roger's legal battle takes on broader significance. His defense is not merely about avoiding extradition, it is about exposing the larger mechanisms of financial control. And so, as the battle unfolds, readers now turn to Roger's defense, a meticulously crafted legal argument standing against an empire determined to silence him. The defense. The case against the DOJ's tax trap. Alright, let's set the record straight. This isn't just Roger Ver's legal fight, this is our fight. At Buildcoin, we've spent years dissecting tax laws, monetary policy, and the hidden mechanisms that governments use to maintain control. And we're not just talking theory. We've built a rock-solid legal defense that has an extremely high chance of winning against the Department of Justice, but more importantly than winning the hearts and mind of the judge in his legal case, the goal here is to win the minds of the public, all investors in Bitcoin and all the mistaken anarchists and libertarians who harp on about money backed by gold or Bitcoin as if these solutions are practical or ethical. If Roger Ver becomes yet another political prisoner, then the record needs to be set straight and the minds of the objective public need to hear both sides of this story. This case isn't about tax evasion. It's about how governments are manipulating the definition of Bitcoin gains to justify unjust taxation. They want to treat Bitcoin like a traditional asset, applying capital gains taxes as if it's a stock or a house. But here's the problem, Bitcoin isn't like anything that's existed before. It's not tied to a single jurisdiction. It's not controlled by any government. And, most importantly, its price movement isn't purely about market speculation. It's a direct mirror of fiat currency devaluation. Governments have backed themselves into a corner with their own monetary policies. They flood the economy with newly printed money, causing inflation, and then try to tax Bitcoin holders for merely holding an asset that reflects that devaluation. That's not a gain, that's just basic economics. And that's where we come in. The case is based on outdated, jurisdictionally flawed tax laws that were never designed to handle a borderless, decentralized asset like Bitcoin. The IRS classified Bitcoin as property in 2014, but they're trying to apply taxes retroactively, which is a major due process violation. The government wants to tax Bitcoin like real estate or stocks, but real estate is physically located within a specific country. Stocks are issued by a specific company. Bitcoin is neither. It's traded globally, valued across multiple currencies, and not tied to any one jurisdiction. The DOJ's entire case rests on outdated tax frameworks that don't account for the global, decentralized nature of Bitcoin. If they can't define where the gain actually occurred, they have no case. Bitcoin's price increases aren't just speculative profit. They're also a direct reflection of inflation across global fiat currencies. The US government wants to ignore this fact and pretend that Bitcoin's rise is purely about appreciation rather than the erosion of purchasing power they themselves have caused through monetary expansion. They print trillions of dollars, devalue their own currency, then turn around and tax Bitcoin holders for an artificial profit. That's double dipping, and we're calling them out on it. This case is bigger than Roger Ver. It's about the precedent that this case will set for every single inflation hedge or any solution that finds a legitimate way to ethically and practically hedge against private bank fiat inflation. If the DOJ wins, it means governments can ignore economic reality, weaponize tax laws, and apply them retroactively to anyone or any solution they deem a threat. But if they lose, it sends a message. Bitcoin is not property to be taxed like real estate, and more importantly, fiat devaluation should not be treated as taxable gains. The legal battle is coming, and we're ready. The next step is a deep dive into the full legal defense we've prepared, one that challenges the very foundation of the government's argument. Defense Augment 1. Speculative gains are not inflation-driven gains. Let's begin by clearing up one of the most dangerous misconceptions at the heart of Roger Ver's case, the idea that Bitcoin's rise in price represents a speculative gain, and that this rise should be taxed accordingly, like flipping a house or a stock. But what the US government calls speculative gain is, in reality, a mischaracterization, a legal illusion built on an outdated framework that fails to account for inflation. To understand why, we have to start with the nature of inflation itself. When a government increases the money supply, when it prints trillions of dollars and injects that money into the economy, it doesn't just stimulate activity. It devalues the currency. It dilutes purchasing power. Every dollar in your pocket becomes worth less. Prices rise, not because assets are more valuable, but because the measuring stick, fiat currency, has shrunk. Now, Bitcoin is different from traditional assets like real estate or equities. It doesn't produce earnings. It doesn't generate rent or dividends. What gives it value is scarcity, fixed supply, global liquidity, and resistance to manipulation. Bitcoin's price goes up, not as a reflection of speculative demand, but as a response to fiat erosion. It becomes a measuring stick for the collapse of another measuring stick. So when the IRS or the Department of Justice looks at Bitcoin and says, "You've made a gain, and now you owe tax," they are deliberately ignoring the role of inflation in driving that gain. It's not appreciation, it's preservation. It's not profit, it's purchasing power catching up to monetary debasement. And taxing someone for that is like taxing a homeowner because their house is still standing after a flood. The waters rose, the house didn't move. Here's where the legal argument becomes razor-sharp. The burden of proof is not on Roger Ver to prove that inflation caused Bitcoin's rise. It's on the government to demonstrate that his gains were speculative in nature, that they were independent of inflation, that they were tied to market timing or insider advantage or some kind of manipulation. But that case falls apart under scrutiny, because Bitcoin's rise was not unique to one market or one player. It moved consistently with fiat money supply expansion. And here's something even more dangerous for the government: if they admit that inflation drove Bitcoin's price increase, they also admit their own role in it. They become the creators of the condition they now seek to tax. That's not speculation, that's circular logic. That's taxing people for reacting rationally to government policy. And in legal terms, that's a conflict of interest that undermines the entire foundation of the claim. From a constitutional perspective, due process requires clear, fair notice of what constitutes taxable income. But how can it be fair or legal to define gain without first accounting for inflation? And not just US inflation, but global monetary conditions that affect Bitcoin's valuation on every exchange around the world. We'll get to that in the next section. For now, understand this: taxing Roger Ver, or anyone else, for Bitcoin's rise in an inflationary environment is like fining someone for buying a fire extinguisher before a fire. It punishes foresight. It rewrites economic logic. And it violates the most basic principle of just taxation, that only true profit, not survival, should be taxed. Defense Augment 2, Bitcoin responds to global inflation, not just US jurisdiction. Let's talk about what the government keeps getting wrong. It's not just the idea that Bitcoin's price rise is speculative, it's the assumption that Bitcoin is somehow tethered to the United States. That it should be measured only in US dollars, taxed under US definitions of profit, and treated like a domestically located asset. But here's the truth: Bitcoin is international. Decentralized. Borderless. That means it is influenced by the monetary actions of not just the Federal Reserve, but every central bank on Earth. The European Central Bank. The Bank of Japan. the People's Bank of China. Every time any of those institutions prints new currency or devalues their national tender, they put upward pressure on Bitcoin. Not because Bitcoin is gaining speculative value, but because fiat currencies, one by one, are losing credibility in strength. And since Bitcoin is priced globally in dozens of currencies, its rise reflects this broad, synchronized inflation. Now, the US government is trying to measure Bitcoin's gain strictly in terms of its dollar value. That's like trying to judge the height of a mountain using a ruler that keeps shrinking. It ignores how the rest of the world affects that measurement, account for the international forces that shape its price. Otherwise, you're taxing someone for escaping your own economic dysfunction, while pretending other countries don't exist. Legally, this is a problem. Because U.S. tax law does not have automatic jurisdiction over global economic behavior. In international taxation, there's a basic concept: you can only tax what you can prove is connected to your jurisdiction. That's called nexus. And Bitcoin? It doesn't sit in a U.S. vault. It isn't issued by a U.S. company. It isn't stored in a U.S. bank. It exists everywhere, traded 24/7, and measured in every major currency. To claim that its gains belong solely to the United States is to ignore that reality. In court, the government would have to prove that the gain occurred within U.S. jurisdiction, using U.S. monetary conditions as the benchmark. But that would be misleading. Because when you zoom out and look at the data, Bitcoin's biggest price jumps often follow global monetary expansions, not just American ones. And if the asset is rising in response to international inflation, then any tax claim that doesn't factor in global currency devaluation is fatally incomplete. Now, here's the deeper issue: by ignoring international inflation, the government creates a distorted picture of value. It presents Bitcoin's price in US dollars as if it were an objective truth, when in fact, it's just a reflection of the dollar's weakness relative to other currencies and to Bitcoin's scarcity. And that makes the tax claim more than just economically flawed, it makes it legally fragile. Because the government is applying a domestic tax framework to a global financial reality. And there's precedent for this. In international tax law, when assets are affected by foreign exchange rates, foreign inflation, or global forces, those factors must be considered before calculating taxable gains. You don't get to cherry-pick the part of the picture that favors the government's revenue, and leave out the part that shows a lack of true economic profit. That would violate not just the principle of fairness, but constitutional protections under due process. So let's call it what it is: this isn't a national tax issue. This is a global monetary reaction. And unless the government can quantify the total inflationary impact of every major fiat currency involved in Bitcoin's rise, and subtract that from the supposed profit, they don't have a legitimate tax claim. What they have is a domestic lens pointed at a global phenomenon. And Bitcoin doesn't live in that lens. It lives everywhere. Defense Augment 3, it's not an average, it's a gang now. Before we move on, there's one more crucial point we need to clarify, because this is where most people, including the government, completely miss the scale of what's happening. When we say Bitcoin responds to global inflation, we don't mean the average global inflation. We're not talking about some blended percentage pulled from the IMF or an index of currencies. No. What's actually happening is that Bitcoin is being hit, in series, by the inflationary pressure of every single fiat currency it's traded against. And that's a different game altogether. This isn't like getting hit once and walking it off. It's like getting hit again, and again, and again, each time by a different currency, each time by a different central bank printing more money. The US prints trillions. The Eurozone follows. All expand their monetary bases. And Bitcoin, sitting there with a fixed supply, absorbs the full cumulative effect of that debasement. Not an average. An accumulation in series. Stack it up. Add them one after the other, because that's how the inflation builds. And here's where the metaphor lands. Imagine a fixed, motionless object, something like a single protester standing in a circle. Now imagine that protesters surrounded by a gang, with each member representing a different currency. They all take turns pushing, one after the other. No single shove defines the motion, but the total effect of all those shoves, in sequence, creates unstoppable force. That's what happens to Bitcoin. It is the only asset, truly the only one, that is simultaneously priced against every major fiat currency on Earth. And those currencies aren't coordinated. They're all printing at different rates, for different reasons, at different times. But the result is the same. Bitcoin is under constant, multi-directional inflationary pressure from the entire fiat system. It doesn't matter if one currency is stable while another collapses. What matters is the total combined effect of all fiat debasement hitting a fixed supply asset. It's not just inflation, it's a structural assault on a single, unmoving unit of economic truth. And that's what the government is trying to tax. But unless they account for the full cumulative debasement, not averaged, not modeled, but actually tallied across all markets, they are presenting a distorted picture. They're claiming that Bitcoin rose due to investor speculation, when in reality, it rose because every fiat currency took a swing. Every one. And that pressure? It doesn't reflect profit. It reflects Bitcoin's refusal to inflate in a world where everything else does. So before we talk about reputation risk or political fallout, we have to acknowledge this: Bitcoin isn't just an asset resisting one government's inflation. It's standing against the entire gang of central banks, and still holding its ground. Defense Augment 4, the tether trap, synthetic inflation and the mirage of fair market value. Now before we move on, there's one more piece of this puzzle that must be addressed. Because it's not just global inflation that distorts Bitcoin's price, it's synthetic inflation, too. And that synthetic pressure comes from one entity, Tether. Tether is the so-called stable coin that is supposedly pegged one-to-one to the US dollar. It's the largest source of crypto liquidity in the world. But here's the problem: Tether has never been fully audited. It has never conclusively proven that it's backed by real reserves. And yet it has printed tens of billions of tokens into existence, tokens that are directly used to buy Bitcoin and pump up the market. That's not a neutral market condition. That's manufactured demand. Now why does this matter for Roger Ver? Because the government is asserting that Bitcoin had a determinable, objective, and fair market value, first at the time he renounced his citizenship in 2014, and again in 2017 when his companies allegedly sold Bitcoin. But here's the catch: if Bitcoin's price was inflated by Tether, and if Tether turns out to be a Ponzi scheme, then any valuation based on that market data is inherently corrupted. This is where things get very serious. One where they are seen not as the enforcers of the law, but as the architects of the very economic instability they now pretend to police. This is a political checkmate. Let me explain why. First, this defense exposes the inherent hypocrisy in the tax claim. The government inflated its own currency, created the conditions that pushed Bitcoin upward, and now wants to tax that reaction as if it were profit. They weaponized the money supply, then turned around and called the escape hatch a taxable event. That's not justice. That's predation. And when that logic is made public, when people see that Roger Ver is being pursued for protecting himself from inflation that the government caused, it will resonate far beyond the crypto world. Second, this case invites scrutiny into something they'd rather not talk about: Tether. If this defense raises serious doubt that Bitcoin's historical prices were inflated by a potentially fraudulent, government-tolerated liquidity scheme, then every person who has ever paid taxes on Bitcoin has grounds to question those assessments. It opens Pandora's box. It calls into question the integrity of the market, the ETF approvals, and the institutions that benefited while dissenters were punished. And here's the third piece: timing. This trial isn't happening in a vacuum. It's unfolding in an era where trust in government, trust in monetary policy, and trust in financial institutions is crumbling. People are watching banks collapse, watching inflation steal their savings, watching asset prices soar out of reach, while being told to tighten their belts and pay their fair share. If the government is seen to be persecuting a man for leaving that system and surviving outside it, the narrative flips instantly. Roger Ver becomes not a fugitive, but a symbol. Now, the DOJ may believe it can win this case quietly. That it can frame Ver as a wealthy exile dodging responsibility. But this defense doesn't let them stay in that story. It forces them to explain, in detail, the mechanics of fiat inflation. It forces them to defend Tether. It forces them to argue that international forces don't affect Bitcoin, an argument any economist will struggle to make without looking like a fraud. And worst of all, for them, it forces them to have this argument in public. If they press forward, they don't just risk losing in court. They risk losing face. Because if the public begins to understand that this case is about punishing someone for resisting monetary debasement, they won't side with the tax man, they'll side with the escape artist. This is why the strategy works. It transforms the trial into a referendum on monetary policy, inflation, and financial manipulation. It exposes the DOJ's selective enforcement and the quiet partnerships behind the scenes. And it makes one thing perfectly clear: if Roger Ver is punished for protecting himself against a failing system, then the system is not just broken, it's vindictive. That's not a good look. Not for Washington. Not for the IRS. And not for anyone who still believes in the illusion of a free market, the private money logical fallacy. Let's consider this. Roger Ver and many libertarians and anarchists see government-controlled money in central banking as an overreach of power, mainly because of their distrust of government due to personal experiences. Their belief is that decentralized money or gold-backed currency would be a solution. Central banks, which control the creation of money, are not actually under direct government control. In practice, these central banks are private entities that operate independently of the government, and their employees are immune from legal actions or government oversight in many cases. So, the idea that government control of money is the root problem is itself a misunderstanding. The real issue lies in the fact that money creation is already in private hands, and regulations are not evenly applied. This brings us to the deeper contradiction in the views of libertarians and anarchists. They often argue for decentralized systems to avoid the centralization of power, but the private entities running central banking already have more power than they realize. On top of that, we can look at how traditional financial markets have operated, especially following the 2008 crash. During that time, many of the same issues that plague crypto markets today, such as banks misusing customer deposits, occurred within regulated markets. Banks used people's deposits as if the money were theirs to invest in high-risk ventures, and when the markets crashed, some companies, like Lehman Brothers, went bankrupt, but the majority were bailed out by the government, read, taxpayers. This bailout led to inflation and ultimately benefited the same players who caused the problem, all without punishment. The problem wasn't unregulated markets, it was the regulation itself that allowed banks to misappropriate funds with no real consequence. Now, let's compare this to the crypto space. We've seen cases like Gox, where Mark Karpelès was sent to prison despite the hack that stole 650,000 bitcoins. Even though the evidence suggested the hack was the cause, Karpelès ended up facing prison time, while the company Tulip, which ran Gox, kept much of the seized assets and eventually profited. The company's legal battles and bankruptcy proceedings ensured that the value of the assets was locked in at the time of the crash, but when those assets appreciated dramatically in value, the creditors only received the dollar amount equivalent to the price at the time of the bankruptcy, while the company and the lawyers benefited. The same thing happened with FTX and Sam Bankman-Fried, who is now facing a 25-year sentence for using customer funds to trade and gamble in other assets, similar to what happened in the traditional financial system. But the difference is that in the traditional finance world, this kind of behavior is overlooked or even encouraged, through bailouts and other protections, while in crypto, it leads to criminal charges and imprisonment. The real contradiction is that those operating in traditional markets, where regulation supposedly exists, are given a free pass to engage in the same behavior, while those in the unregulated crypto markets face far stricter enforcement. This double standard raises a critical question: why are crypto actors being punished so harshly for the same actions that are allowed, and even supported, in the traditional financial space? Could it be that the system's true flaw is not that it's unregulated, but that regulation is unevenly applied, punishing individuals in one market while protecting the powerful in the other? Having second thoughts, believe in the principles of free markets and the power of the original Bitcoin? Today, he's open to exploring other decentralized projects beyond Bitcoin Cash, now championing money truly free from central banks. But given his history, it's worth asking, has Bitcoin failed in his eyes? Is the world's most vocal Bitcoin evangelist now questioning the very experiment he once led? This becomes even more intriguing when you consider his current legal battles. Facing a potential 90-year prison sentence, stemming from the very asset he believed would set him free, does Roger now see this as proof that decentralized money is needed more than ever? Or is he recognizing the contradictions within the ideologies of libertarians and anarchists who envisioned a world free from government control and central banks? The irony is hard to ignore: the very system Roger thought would free him has now put him in this precarious position. He was once Bitcoin's loudest advocate, calling it a peaceful revolution. But it wasn't until he started criticizing Bitcoin, pointing out its flaws and the forces that hijacked its mission, that the state came after him. His legal troubles didn't begin with his promotion of Bitcoin, but when he began questioning it. Does this suggest Bitcoin was only acceptable as long as it served the narrative of a controlled revolution? Is there an unspoken message here: promoting Bitcoin makes you rich, but challenging its flaws leads to silencing? If that's the case, the biggest question remains: was Bitcoin ever really free to begin with? Epilogue: From Tether to Andorra Gate, the power they wield and the silence that speaks. In the next episode we will expand on the concept of power too, and here's what makes this all even more disturbing. If the US government wanted to shut down Tether, they could do it tomorrow. Not with a raid. Not with lawsuits. Just one notice. We've seen it before. In the case of Banco Privado de Andorra, or BPA, a simple notice from FinCEN, the U.S. Treasury's Financial Crimes Unit, was all it took. One memo. One advisory. And the entire bank was instantly blacklisted from the global financial system. Why? Because any institution that touches US dollars must obey that signal. BPA didn't even have a chance to defend itself. Overnight, it was cut off from the dollar, shut down, and sold off, dirt cheap, to a vulture fund. A $500 million institution reduced to $13 million in a matter of months. No trial. No appeal. Just the raw exercise of financial power. And the scandal, now known as Andorra Gate, is no longer a theory. It's a matter of public record. It was a political hit job. The attack on BPA wasn't about crime, it was about crushing dissent. The Catalonian independence movement in Spain was gaining traction, and BPA's perceived association with regional political currents was enough to justify the move. The result? Millions in customer funds lost, a sovereign financial institution dismantled, and American influence extended far beyond its borders. So now ask yourself, if FinCEN can shut down a regulated European bank overnight, with one word, why hasn't it done the same to Tether? Tether has never been fully audited. It holds more systemic risk to the crypto ecosystem than any bank ever did. Its ties to market manipulation are widely documented. And yet, silence. Why? Because the same institutions prosecuting Roger Ver are benefiting from Tether's existence. Because Tether props up the illusion of a healthy market, feeding the ETF narrative, pleasing Wall Street, and helping regulators like the DOJ create a trail of taxable events that only exist because of a synthetic bubble they silently endorse. And that's the final turn in this story: Roger Ver is not being prosecuted for what he did. He's being prosecuted because he opted out of a hijacked system that rewards corruption and punishes dissent. And when you understand that, you understand why this defense matters. not just for Roger, but for all of us. And that brings us to the next chapter, Andorra Gate. A story not about crypto, but about control. About what happens when a government doesn't just enforce the law, but uses its financial power to break it. That's where we're going next. Bitcoin is truly free. Whether governments can retroactively tax monetary debasement. Whether dissent is still allowed in the financial system. If Roger Ver loses, the message is clear: challenge the system, and you will be crushed. But if he wins, it changes everything. And that is why we fight.